Welcome back to Markets and Noon right here on ET Now, and let's welcome on board Sorbh Gupta, Senior Fund Manager of Equities at Bajaj Finserv AMC, joining us on the show right now. Good afternoon, Mr. Gupta, and thank you so much for your time. Firstly, help us understand what are you penciling in for the Indian markets, because we just concluded the Q4 earnings season. Overall, what the reports have been highlighting and what we did witness as well is that the numbers were not that bad versus the street estimates. So how are you looking at the cues that are boding well for the Indian markets, and where do you see them headed?
Thank you. Good afternoon, and thank you for inviting me. Very rightly said that the Q4 numbers have been either in line for majority of the companies or have they beaten estimates. That's the good thing, and this is coming after good 6 months of healthy correction that the markets have witnessed, including the broader markets. So going forward, especially for the domestic-oriented businesses, we feel things are improving. The input costs are reducing, so that's a positive. So overall, we see FY26 to be better than FY25 for large part of the company that we cover in our universe as part of the mutual fund. So that's positive for us. And we also feel that it's still a little more care needs to be taken while looking at the export-oriented businesses, because globally things are still not stable. That is both positive and negative. While our export sector might not do that well, but as domestic economy recovers, India again gets that TINA factor, which helps it attract a lot of capital, which has been seeing outflow for last 6-7 months, barring May. So overall, things looking better. FY26 for large part of the economy should be better than FY25, and uh, the beta on the portfolio should increase, and there's a time to take a little more risk in the portfolios.
All right, Mr. Gupta, hi, this is Ankita also joining in. Good afternoon to you. So, you said that it is time to perhaps start to have the risk on sentiment back or bring it back on the table. But what are these sectors that you see value in? Where can you place your bets? You know, if I look at your portfolio, I see a lot of large cap names there. So, clearly there is some sort of a comfort, a valuation comfort that you have in the large cap names. But when you speak about the risk on sentiment, that is usually taken in the SMIDs space, right? The small and the mid caps. What do you make of that part of the market?
A good question. So around 6 months ago, we had reduced our exposure to mid and small caps, but over the last 1 month, we have increased our exposure to small and mid caps. Clearly, after the earnings season, we have clearly seen some of the pockets within mid and small caps also, which are seeing earnings growth and a decent correction. So the valuation have become comfortable. In the large cap space, the best part is that the valuation comfort is most of the sectors there is valuation comfort. In mid and small caps, so what is happening is there are clear pockets of comfort that are emerging. So talk to you on this. So rate sensitive is something that we are very positive on. So rate sensitive sectors across the board, large, mid, and small, we are getting very positive. We believe with more round of rate cutting cycle that can happen, there could be a major boost. So NBFCs is a pocket that we like. We also like real estate across the board, large, mid, and small, that we have been adding. So that's clearly positive. Some of the smaller banks, tier two banks, which have more of wholesale funding than CASA, is something that we are liking and we are adding. So all these things will do well, especially, and we are also looking at some of the consumption sectors. We believe that there will be a clear consumption revival where monsoons are better than expected, earlier than expected. The tax cuts that the government had given in the budget will start to play out from this festive season, and a lot of rural spends that this government is doing through these largely Behna schemes that will also usher some consumption push that will happen. Top it that the food inflation is cooling off very rapidly. This means the consumer will have more money to spend on the discretionary part of his consumption. So all these things are looking good, and our portfolios are getting positioned towards that.
All right. Along with that, Mr. Gupta, give us some sense that which are the sectors where you are most bullish on. We do understand that financials is one such pocket wherein you and most of the other market participants are finding some sort of a respite and valuation comfort as well, and even the earnings did bode well. But other than financials, any other pocket where you believe that for the next couple of quarters there will be an upside, or rather there is a possibility of a surprise on the earnings front?
Yes, clearly, within financials, insurance is something looking good. Within financials, tier two banks look good, NBFCs look good. So that's a pocket that should see earnings surprise. we believe that the demand will positively surprise on the real estate sector as well. So in terms of pre-sale numbers, I think real estate is a sector that will surprise all of us, as I talked about interest rate sensitives. So that is positive. Some of the chemical names are something which could see positive earnings surprise. Some of them have completed their capex. I think demand is falling in place. So that is also one thing that we are liking. We are also liking very few, but some of the companies on the staple side where the input cost is coming off very, very rapidly, and some consumer discretionary name on the QSR side. So all these things clearly appear positive to us, and we are positive, and we have been adding. We are underweight IT, and we have reduced our weight on pharma, which are export oriented for the reasons that I highlighted in the earlier question.
Right. Mr. Gupta, we also saw the numbers coming in on India's GDP, which gave a good positive upside surprise of 7.4%. That was more than what we were penciling in, which was also driven by activities in construction and the manufacturing side of it. Now, while the public capex is in line, there is a slowdown in as far as the private capex is concerned, the private investment is concerned. Do you see that picking up? Because that could also bode well as far as that part of the economy is concerned. And also, what do you make of what do you make of the manufacturing space? Is that likely to pick up going ahead?
This whole private sector capital expenditure is something which has been the missing part of India's GDP growth for long now. And while government has tried its best in terms of tax cuts and a lot of incentives through PLI to push this in terms of capex on the private side, but that is not taken up rapidly. It's not moved up, and it's been the missing part of the whole jigsaw of the Indian GDP. What we feel is that as the consumption picks up and the utilization levels of factories go up, I think that could be a reason why private capex should pick up from here on. So maybe not now, maybe 6 months down the line, but when the entrepreneurs see that their capacity utilizations are moving up, they will set up newer factories, maybe not for tax incentives, but for real demand that will come through as consumption picks up. So we are positive, but maybe it'll be a second order derivative impact after the consumption picks up for next 6 months. We have to see how the festive season goes. And if there is a strong demand on the consumption, I'm sure the manufacturing will continue to do well, and we'll see increased capex that will come through on the private side, which has been missing for long now.
Right, and Mr. Gupta, while we talk to you right now, on the bottom of your screen, we have a news flow coming in with respect to the new EV policy in India, where the government is highlighting the fact that Tesla as a play is not interested in the Indian markets, but along with that, they have also announced that they have reduced the tariff of 15% for the next 5 years, and that's allowed to import the EVs priced at $35,000. Give us your first thoughts on this one, if at all, because I remember that when there was so many news flow around that Tesla is finally looking to go ahead and set up in India, and there were also reports highlighting that they have also started some of the hiring process in Indian markets as well. There was a bit of a jitteriness and nervousness within the Indian OEM, the large caps from the likes of Tatas and Mahindras. But how do you see this news flow, and what's your overall takeaway for the Nifty Auto right now?
We have also been closely watching this space, and we have been very careful of companies in India who produce EVs, especially with these policies change. There could be essentially a cap on how much expensive cars they could sell, because some of these big companies could come into India. So it's an evolving situation. I think it's been a couple of years of discussions between Tesla and the government of India. And one should look at this sector, especially from an imports perspective or MNC's perspective, beyond Tesla. There are enough large companies globally which would be interested in government policy to bring in capacities here. I think some of the companies are already trying to set up Indian capacities and plants. And finally, India is too large a market to ignore for anyone. So I'm sure there will be discussions and negotiations between government and larger companies who want to come and set up a base. But it might take some time. While we have also heard that some of these larger companies have started to set up offices. So there is something that is evolving. But I think for Indian auto companies, most of these operate below that threshold of the minimum price tag that the government has announced. So as of now, we don't see a threat on the current demand of the EVs that the Indian companies have launched. On specific Nifty auto, while there has been weakness in demand, but what we believe is as we get a little more positive on consumption discretionary, and auto is a big consumer discretionary, I think over a period of time, next 3-6 months, as the demand on the festive season will be a critical point that we need to watch out for. How are the channel fills happening? We are a little more positive on the PV side rather than the two-wheeler side, but we have to see how this situation evolves. As of now, we are an underweight, but we believe as consumption picks up and there is a little more discretionary income in people's hand, this sector should revive rather quickly. But it's a keenly watched sector for us, like.
Right. Also, Mr. Gupta, let me bring back to you what you had mentioned in your first answer, that we would perhaps be looking at consumption also, because you see a consumption revival as well because of the tax cuts, and also the fact that the food inflation is is declining, the food prices are easing out, and that will give a lot of money in the hands of the people to spend on discretionary spends, and therefore the consumption picking up. Which pockets within the consumption basket are you seeing value in? Because if you look at the aviation or the hospitality sector, they've already run up quite a bit. So where are these pockets of consumption that you see value in?
Yes, so consumption, if you see last 3 years also, it's not that it was not doing well, but it was more of premium consumption that was doing well. Now, what consumption that I'm talking about is more mass consumption, bottom of the pyramid or mid pyramid level consumption that should pick up. So I need to focus on companies which services those customers, which are kind of a little more on the margin. And now with some government support on taxes, government support on free doleouts, cash doleouts, and easing of the inflation, that pocket I think is something one should watch out for. So companies within auto may be producing mass products rather than premium products. Mass housing companies who produce mass housing. We are also positive on building materials space. We believe there is a real estate cycle which is getting completed. A lot of homes will get delivered in next 1.5 years. So that is a late cycle play on the real estate. So that is also one thing which is on consumption that we are very, very bullish on. We are a little more careful on staples, while staples is something which has really underperformed. So that is also a sector which we are keenly watching, especially with the input costs cooling off and some volume growth coming back after good monsoon. We believe EBITDA growth and some of these staple companies could positively surprise. So these are the clear pockets that we are keenly watching on in terms of consumption. We are also looking at consumer durables, some of the consumer durables who could benefit from this.
All right, Mr. Gupta, with this, we let you go on that. Thank you so much for taking the time out and giving us a sense that what are you really penciling in when it comes to Indian markets and the sectors thereon. Thank you so much for your time.